Imagine a product so pervasive that it earns money without making anything. A product so familiar that most people never notice they purchase it daily throughout their lives. That product is debt. Far from being a neutral financial tool, debt has been engineered into the most lucrative product ever created. It has financed wars, reshaped empires, bound nations, and silently transferred wealth away from ordinary people. Yet ask where debt originated, who refined it, and why it governs the modern economy, and most people cannot answer. The history of debt is not merely economic. It is a history of authority, obedience, and power. At its core, debt is a promise. You receive value now and commit to repayment later. Hidden inside that agreement is the mechanism of control, interest. Interest converts time into revenue, transforms obligation into profit, and ensures that the future itself becomes a source of extraction forever, systematically. For much of human history, debt was treated with suspicion rather than admiration. Early civilizations understood that obligation could stabilize trade, but they also recognized how quickly it could fracture society. In ancient Mesopotamia, debts were etched into clay tablets, formalizing promises between lenders and borrowers. Yet those same societies periodically erased those obligations through debt cancellations, not out of charity, but necessity. Rulers learned that when too many people were locked into permanent repayment, social order broke down. Farmers lost land, families lost freedom, and unrest followed. Debt, left unchecked, was not productive. It was This understanding echoed across cultures. In the Hebrew tradition, debt forgiveness was embedded into religious law. Every 50 years, obligations were to be wiped clean. The logic was blunt. If debt accumulated endlessly, it would convert free citizens into servants. Economic imbalance would become political weakness. These early systems treated debt as a dangerous force that required limits. But history did not move toward restraint. It moved toward refinement. As societies grew more complex, elites began to realize that debt did not need to be erased. It needed to be controlled. In medieval Europe, the Catholic Church formally condemned usury, declaring interest-taking immoral. Money, it argued, should not reproduce itself. But commerce demanded credit, and merchants found ways around moral restrictions. Loans were disguised as partnerships. Interest was hidden inside exchange rates, fees, and penalties. The letter of the law was obeyed, while its spirit was quietly dismantled. By the Renaissance, this financial creativity had produced a new class of power. Banking families in cities like Florence and Venice built influence not through conquest, but through credit. The Medici did not rule by armies. They ruled by balance sheets. Kings and popes required money to govern and fight wars. Bankers provided it. In return, they gained political access, legal protection, and influence over policy. Debt was no longer a simple transaction between individuals. It had become an instrument of leverage. The decisive shift arrived with the rise of state debt. In the 17th century, the Dutch Republic pioneered a revolutionary idea. Governments could borrow from their own citizens by selling bonds. Investors purchased claims on future tax revenue in exchange for regular interest payments. These bonds could be traded, sold, and inherited. War financing was transformed. No longer constrained by existing treasure, states could fund conflict by monetizing the future. England refined this system further. The founding of the Bank of England in 1694 formalized national debt as a permanent feature of governance. The state no longer borrowed sporadically. It borrowed continuously. Debt was rolled over, renewed, and expanded. The government paid interest, not principal. Bankers became essential partners of the crown, managing issuance, stabilizing markets, and ensuring confidence. Debt migrated from emergency measure to structural necessity. The incentives were irresistible. Lending to governments was safe. States could tax their populations to meet obligations. War, once financially ruinous, became sustainable. The more conflicts erupted, the more debt was issued. The more debt was issued, the wealthier creditors became. By the 18th century, bond markets in London and Amsterdam formed the backbone of global finance. Empires expanded on borrowed money. Armies marched on credit. Conquest itself was leveraged. As industrialization spread, debt penetrated deeper into everyday life. Factories, railroads, and canals required enormous upfront investment. Credit supplied it. Workers earned wages from enterprises funded by loans, then borrowed themselves to survive. Housing, tools, and basic necessities increasingly required financing. Debt ceased to be exceptional. It became normal. By the 20th century, borrowing was no longer reserved for states and merchants. It was mass-produced. Mortgages, installment plans, and consumer credit brought debt into households. The promise was opportunity. The reality was dependence. Debt embedded itself into daily existence, shaping decisions, limiting freedom, and aligning entire populations with the logic of repayment. What began as a tool to manage scarcity had evolved into a system designed to sustain obligation indefinitely. What made debt so powerful was not merely its scale, but its design. Unlike goods that are produced, sold, and consumed, debt generates returns over time. Every payment extends the relationship. Every delay increases profit. Interest transforms obligation into a recurring transfer of wealth, steadily moving resources from borrowers to lenders. A mortgage stretches across decades. A revolving credit balance compounds quietly. What begins as access becomes entrapment. Debt is engineered to endure. By the mid-20th century, this logic had been embedded at the highest levels of the global economy. The aftermath of the Second World War produced a new financial order. Formalized at Bretton Woods in 1944, the International Monetary Fund and the World Bank were presented as institutions of stability and reconstruction. Their public mission, their operational mechanism was lending. Countries could access capital, but only under specific conditions. Debt became a means of enforcement. Loans were accompanied by policy requirements. Governments were instructed to cut spending, privatize assets, and restructure economies to ensure repayment. These structural adjustments reshaped entire societies. Social services were reduced. Public industries were sold. Domestic priorities were subordinated to creditor demands. Sovereignty was quietly compromised, not through invasion, but through obligation. Debt functioned as a disciplinary tool. At the same time, banks discovered a more reliable source of profit closer to home. Households represented an untapped market. In the decades following the war, consumer lending expanded rapidly. The mortgage became central to middle-class identity. Homeownership was framed as success, stability, and belonging. Yet the price of entry was long-term indebtedness. Families signed contracts committing decades of future income in exchange for shelter. Security came with conditions. This shift altered behavior. Debt lost its stigma. Borrowing was no longer associated with desperation. It was marketed as progress. Advertisements promised convenience, comfort, and upward mobility. Buy now, pay later. Enjoy today, worry tomorrow. Credit cards removed friction from spending. Installment plans normalized repayment as a permanent feature of life. The future was continuously For financial institutions, the results were extraordinary. Millions of small loans produced predictable cash flows. Interest compounded quietly across populations. For governments, consumer credit masked deeper problems. Stagnant wages no longer limited demand. Growth could be sustained artificially through borrowing. For corporations, credit-insured customers could afford products regardless of income. Debt lubricated consumption. Crucially, the system did not reward repayment. Banks preferred rollover. Refinancing extended profit streams. Late fees and penalties increased margins. The longer debt persisted, the more valuable it became. Governments adopted similar logic. Borrowing was politically easier than taxation. Costs could be deferred beyond election cycles. Central banks supported this expansion by supplying liquidity, ensuring credit remained available. Debt became structural. The consequences emerged slowly. Tin, Sudan. In the 1970s and 1980s, developing nations borrowed heavily, encouraged by Western banks flush with surplus capital. When interest rates spiked, repayment became impossible. The crisis erupted in 1982. Countries defaulted. The response was not relief, but restructuring. New loans replaced old ones under stricter terms. Debt-trapped nations in cycles of dependence. Citizens endured austerity. Creditors collected returns. Meanwhile, financial institutions refined the product itself. Loans were bundled, repackaged, and sold. Mortgages became securities. Debt was transformed into an asset class. Risk was fragmented, obscured, and distributed across markets. Finance shifted focus from production to engineering. The raw material was no longer labor or land. It was obligation. The logic culminated in 2008. Excessive leverage collapsed under its own weight. When defaults spread, the system froze. Governments intervened, not to dismantle the machinery, but to preserve it. Banks were rescued. Losses were socialized. The lesson was unmistakable. Debt was too central to fail. In the aftermath, borrowing accelerated, interest rates fell. Liquidity surged. The solution to a debt crisis was more debt. Global obligations ballooned beyond historical precedent. Growth figures improved, but they rested on leverage. Prosperity became indistinguishable from borrowing. The system survived, but its dependence deepened. As debt expanded, its role shifted from support mechanism to foundation. By the early 21st century, nearly every major economic function relied on continuous borrowing. Governments funded persistent deficits. Corporations leveraged cheap credit to inflate stock prices through buybacks rather than productive investment. Households relied on loans to maintain living standards that wages alone could no longer support. Without new debt, the system stalled. With it, the system survived. Debt became indispensable. This normalization dulled scrutiny. Young adults accepted student loans as unavoidable. Decades of income were pledged before careers began. Housing prices climbed faster than earnings, but credit bridged the gap. Governments accumulated obligations without immediate consequence. Inflation quietly absorbed part of the burden, reducing the real value of money while preserving the nominal structure of repayment. The cost was dispersed, delayed, and obscured. What looked like stability was leverage layered upon leverage. At the same time, debt's profitability reached new heights. Banks no longer relied solely on interest. Entire industries emerged around servicing obligation. Refinancing extended timelines. Collections extracted penalties. Restructuring generated fees. Investors traded sovereign bonds, speculating on the reliability of entire nations. Hedge funds purchased distressed debt, extracting value from collapse. Credit rating agencies became gatekeepers, determining access and price. Debt was not merely issued. It was actively managed, priced, and exploited. The effect on wealth distribution was profound. Every interest payment transferred resources upward. Millions of small obligations fed concentrated balance sheets. Those with assets borrowed cheaply, amplifying returns. Those without paid premiums, trapped by necessity. Debt reinforced hierarchy while appearing neutral. It rewarded ownership and punished dependency. Over time, inequality hardened. Opportunity narrowed. Obligation became inherited. Yet the system continued to evolve. Central banks began exploring digital currencies, introducing the possibility of programmable money. Transactions could be tracked. Conditions could be embedded. Access could be automated. Loans might be approved or denied by algorithms. Interest rates adjusted instantly. Penalties enforced without delay. Efficiency increased. Autonomy diminished. The same logic that shaped debt for centuries now migrated into code. Supporters framed this evolution as progress, faster payments, greater inclusion, improved stability, but history suggested caution. Efficiency for creditors had always meant constraint for debtors. Control followed obligation. The most profitable product in history was not being dismantled. It was being upgraded. The underlying principle remained unchanged. Debt was never neutral. It was designed, refined, and expanded with intent. It converted time into revenue. It transformed uncertainty into obligation. It aligned entire societies around repayment. Financial freedom could not emerge from a structure that depended on indebtedness to function. Understanding debt required rejecting the narrative that borrowing was synonymous with progress. It demanded recognition that easy credit carried hidden costs. Every loan embedded incentives. Every promise contained power. The system did not exist to liberate borrowers. It existed to extract from them. Real resilience emerged elsewhere, from limiting dependence, from prioritizing liquidity over leverage, from recognizing that not all growth was productive, and not all opportunity was benign. History showed consistent patterns. From ancient cancellations to modern crises, excessive debt destabilized societies. The difference was scale. What once threatened cities now encompassed the globe. The story of debt was not merely economic. It was structural. It shaped institutions, behavior, and outcomes. It rewarded patience on one side and urgency on the other. It transferred risk downward and profit upward. And it persisted because it was profitable, protected, and normalized. The most enduring illusion was celebration. Borrowing was marketed as aspiration. Growth was measured without regard to leverage. Prosperity was declared while obligations accumulated. The future was pledged repeatedly in exchange for stability today. This was not accidental. It was systemic. Debt endured because it worked. Not for everyone, but for those who designed it. And as long as obligation remained the organizing principle of the economy, freedom would remain conditional, delayed, and incomplete. History may not replay itself, but its structure is unmistakable. From the debt ledgers of ancient cities to the mortgages of modern suburbs, from early bond markets to today's financial derivatives, the pattern remains unchanged. Debt rewards the creditor, constrains the borrower, and reorganizes society around those who command capital. The deepest illusion is not debt itself, but the celebration of it. The belief that leverage equals progress and obligation equals growth. If this shifted how you see the world, subscribe. History explains the system, and I will show you how to read it clearly, properly,